Right now, we're seeing a ton of people ask for 3-year mortgages. In fact, this seems to be the trend in the mortgage industry. Get me a 3-year, that's all I want, because I think maybe interest rates are going to come down and I'm going to try to time the market. But keep in mind that timing the market is almost always a fool's errand. And you could be making a huge mistake by choosing a shorter term mortgage with the expectation that interest rates are going to come down. And I'm going to discuss exactly why in this video. But before I do me a favor, hit the subscribe button and hit the like button so more people like you can see this video. And if you thought you're already subscribed to my channel and you look down and you're not subscribed, that's because this is a brand new one dedicated to Canadian real estate and finance news. So if you aren't subscribed, make sure you click that subscribe button, and I really appreciate each and every one of you who does so. So let's get into this 3-year versus 5-year versus variable conversation, because it is an important conversation to have right now because of how many people are gravitating towards 3-year rates because of the expectation that they think interest rates are going to come down. And they almost think that it's a certainty. And this might be a mistake, because the reality here is that we can't predict where interest rates are going to go. And the biggest mistake people make, whether it's investing or getting a mortgage or buying a house, is trying to time the market. And it's just not something that can be done well and consistently. I mean, look at 2021 to 2022 and how hard it was to predict what was going to happen with interest rates. I mean, Tiff Macklem, Bank of Canada, pretty much all economists, with the exception of a few outliers like the Scotiabank economists, thought that interest rates were going to stay low for a long time. And then guess what? They didn't. So expectations aren't always the reality, and we need to keep that in mind when we're choosing a mortgage. And I want to show you specifically what's going on right now and why a 3-year might not be the best option. So if we jump in and we take a look at the bond yields, what we're seeing right now is an inverted yield curve. And usually an inverted yield curve is an indicator that there's going to be a recession. And the signs of this are when short-term interest rates are higher than longer-term interest rates. And as you can see from the chart here, right now we have a break basically on the 5-year bond yield. Now, these are the bond yields that fixed mortgages are priced off of. And you can see that longer-term rates are actually lower than the shorter-term interest rates. Now, what this leads to from a mortgage perspective is it leads to short-term mortgages being priced higher. So as of right now, you're looking at basically a 0.3 to a 0.4% premium for a 1 to a 3-year mortgage, which means the 5-year fixed mortgages are significantly less expensive right now than their shorter term counterparts. So the question I have for people who are looking at 3-year or shorter mortgages is, why would you pay a higher interest rate and not guarantee yourself the lower interest rate for longer? And there's some strategies you can use to protect yourself so that if interest rates go down, you can still refinance to a lower interest rate if that in fact happens. Like choosing a lender that's not a bank, that has low payout penalties, that will allow you to move your mortgage to a different lender if you pay the penalty when interest rates go down. So why wouldn't you lock in the lower rate for the long period of time? If interest rates don't go down, you're covered. And if they do go down, then you can make that decision at that point in time. Because if the opposite happens and interest rates go up, well, then at 3 years, you're looking at renewing into a higher interest rate anyways. And then in that scenario, you've ended up paying a higher interest rate for the first 3 years, and you could end up paying a higher interest rate after that. And there is a strong likelihood here that interest rates could go up just as much as there's a likelihood that they could go down. Or what could happen is we could enter a recession. The inverted yield curve always indicates that we are looking at entering a recession, and then that recession ends up being short-lived, and then interest rates go up anyways, well past what they are now. And this is exactly the problem. We don't know what interest rates are going to do. So to try to choose a mortgage based on the expectation that they're going to go down in 3 years could potentially be a mistake. So instead, what we need to do, just like in investing, is we need to choose a framework to choose our mortgages based off of, and we need to stick to that over 10, 15, 25 years. And the framework that we've always chosen for this is the framework that was basically built off the Moshmilevsky study that looked at fixed versus floating interest rates. Now, obviously, floating interest rates didn't do well the last couple of years. It's one of 4 times going back 30 or 40 years that it hasn't. But the framework, at least in theory, suggests that you should always choose the lowest interest rate at the time you get the mortgage. So if you're looking at a mortgage right now and you're looking at 3-year versus 5-year, the 5-year is obviously a lower rate, and obviously the 5-year rates are significantly lower than the variable rates. So therefore, we should choose the 5-year fixed mortgage, put a strategy in place so that if interest rates go down, we can refinance, get a lower interest rate at that point in time, but protect ourselves for as long as possible. Because like I said, there is a good chance that interest rates could go up. And if you want proof of that, just take a look at some of the recent news stories from the Bank of Canada. This one with respect to Tiff Macklem suggesting that monetary policy and fiscal policy are rowing in opposite directions. So in other words, what he's saying here is that the government is doing things that are contrary to the Bank of Canada's fight against inflation, meaning that all the work, all the predictions that the Bank of Canada is making, all the forecasting could be basically thrown out the window if the federal government keeps spending the way they're spending. And if the Liberals or the NDP continue to rule, continue to be in power, and let's call a spade here, they are ruling, they're not really collaborating with Canadians, and they keep spending money to buy votes, well, all the predictions, all the forecasts that the Bank of Canada has in place could really go out the window, and you could see interest rates continue to climb because of the inflationary pressure from the government spending policies. And then if you take a look at the most recent statements from Carolyn Rogers of the Bank of Canada, she is saying that Canadians should not expect to see a world where interest rates are going to go down and that interest rates could essentially stay high for a long period of time, and this will be the new normal. So she's suggesting don't make your buying decisions based on interest rates going down because it may not happen. And there's lots to suggest that that may not happen, especially when you look at the uphill battle that they have to fight spending that the federal government is doing. So here's the thing. I need to be very clear. This is not financial advice. You should not be making decisions based on one YouTube video. You don't choose a variable rate in 2021 after watching one video on variable rates, walk into your bank, and then realize that there's a significant difference between the mortgage that the guy on the YouTube video was talking about and the one that you chose. So this isn't me telling you to take a 5-year mortgage. What this is me telling you to get professional advice, look at all the options, and try not to time the market. Don't make a mistake here because it could cost you a pretty significant amount of money. And if you want that professional advice, if you want somebody from my team or myself to have a conversation with you about choosing the right mortgage and making sure that you aren't choosing something that you don't understand, like many people did over the last couple of years, well, feel free to go to mortgage360.ca, fill out the application, and we'll take care of you. Oh, and if you want more information on how to negotiate a rate, whether it's with your bank or with your broker, let's say you have a friend or a family member that you feel obligated to deal with, or you've got to go into your bank and you can't renew with a different lender, so you got to stick with them, make sure you go to mortgagesecrets.ca, check out my book, Mortgage Secrets. It'll give you all the tools you need in order to negotiate a new mortgage at a better rate. Oh, and if you want more information on rates and what's going on in the market, make sure you check out this video right here.